Did you know your credit score could be costing you thousands of dollars without you even realizing it? I'm Alvaro, and in this video I'm going to go over what makes up your credit score, what hurts it, how to improve it, and how it can affect your finances. Let's start with the basics. What actually makes up your credit score? A credit score is a number between 300 and 850 given to a borrower that gives lenders an idea of how much they can trust a debt to be repaid. It's used when you apply for a mortgage, car loan, or credit card, but it goes much further beyond lending, which I'll explain later. There are 5 factors that determine your score: payment history, credit usage, credit age, mix of credit, and hard inquiries. Now, your payment history is the biggest factor, making up 40% of the score. This measures your on-time payments and any late or unpaid payments, regardless of the amount. One missed payment can take 2 years to recover from, but recent payments matter more than older ones. Once a debt is paid off or negative information is reported, it can stay on your credit report for 7 to 10 years. Next, we have credit usage, which makes up 23% of your score. It measures how much of your available credit you're using. Most experts say to stay below 30% usage. This means if you have $10,000 of credit available to you, try to use $3,000 or less. If you max out your credit lines, your score will likely drop. The next factor is your credit age. It is the average of all your open credit lines you have and makes up 21% of your credit score. Closing out long-standing accounts or opening too many new ones will lower your overall average, which in turn can lower your score. Moving on to your mix of credit, this affects 11% of your score and is based on the types of credit lines you have open. The 2 most common are installment and revolving credit. Installment loans are like mortgages or car loans, where you have a set payment amount for a specific length of time before it's paid off, such as a 20-year mortgage or a car loan for 48 months. Revolving loans are like credit cards or lines of credit, where you can add debt at any time and there's no set payoff date. Having a mix of installment and revolving credit is better for your credit score. The last factor, which makes up 5% of your score, is hard inquiries. A hard inquiry is when a creditor checks your credit report because you have applied for a new credit line. Each hard inquiry will negatively affect your score regardless whether you are approved or not. There's also what's known as a soft inquiry, which does not hurt your score. A soft inquiry is often used by landlords, insurance companies, or potential employers to review your credit report without actually applying for credit. Now let's do a quick recap of what makes up your score. Payment history, 40%. Credit usage is 23%. Credit age is 21%. Mix of credit is 11%, and hard inquiries make up the last 5%. Now that we know what makes up your credit and some actions that can hurt it, let's answer the question, how do you improve it? If you are just starting out and need to establish credit, you can apply for a low interest rate credit card through a credit union. Use that for small purchases like groceries or gas and pay it off each month. This shows creditors that you can be trusted not to overspend and make your payments on time. Paying it off in full also saves you money by limiting the amount of interest that it accrues. If you need to repair or improve your credit, look into free financial coaching. Ascentra Credit Union offers coaching services at all 9 branches. This service is even offered in Spanish. Our coaches do a soft inquiry on your credit so it doesn't affect your score. Then walk through the report to create a custom action plan for you. Our coaches can also help with budgeting, debt reduction, long-term financial planning, and more. You can also use credit monitoring tools like Savvy Money on the Ascentra app. It allows members to view their credit report and shows where they're doing well, where they can improve, and how. This free service to Ascentra members has so much to offer. Now don't pay for credit services, and be aware of the fine print. You never know, some of these services could sell your information to third parties. AnnualCreditReport.com allows you to pull a full credit report once a year from each of the 3 credit reporting agencies, Equifax, Experian, and TransUnion. Make sure to check for any inaccuracies, and if you find any, report them to the relevant credit bureau so that it can be removed and not counted against you. Consolidation lets you combine multiple loans and/or credit card payments into one, offering a lower interest rate, helping you build credit and save money. Consolidations improve your payment history because one payment is easier to keep track of and pay on time. rather than several due dates throughout the month. It helps your mix of credit by moving revolving credit to installment credit and improves your credit usage by freeing up the credit lines that debt is moved from. But it's important not to use those credit lines again and go further into debt. Fight any urge to use them by not carrying them around in your purse or wallet. Just be sure to keep them in a safe place in your home, and remember that closing them will hurt your credit usage and your credit age. Improvements should show on your credit report within a month or so. And remember, more recent positive changes are more important than negative impacts from the past. Let's look at a timeline that gives us the approximate credit weight for each year, because what you have done lately, both good and bad, carries more weight. Here's the breakdown. 40% of your credit score is based on what you've done in the past year. 30% is based on the prior 13 to 24 months, and 20% on the prior 25 to 36 months. That means that 90% of your score is graded off the past 3 years. There's no instant fix to repairing your credit score, but with a little bit of patience and work, mixed with some guidance, you can do it. But why should you do it? Improving your score can make a big difference on your finances. Let's say you're looking to rent an apartment and the landlord conducts credit checks. They may offer it to the person with the highest score, giving you less options for housing. When you apply for a loan, a good credit score not only helps determine if you get approved, but also what interest rate you'll get. The higher the score you have, typically means the less you pay in interest. For something expensive like a mortgage, that can mean the difference of tens of thousands of dollars. Say you plan on buying a home for $250,000 and a bank promoting a 5.75% interest rate says you qualify, but since you're not on the top credit bracket, your interest rate will go up to 6.75%. This is referred to as a loan level price adjustment, a policy that many lenders use to raise your interest rate or charge more fees. Side note, Ascentra does not punish people with loan level price adjustments on fixed rate mortgages. If you qualify for a mortgage, you get the best rate. Now, 1% may not sound like a lot until you do the math. For this example, we will use an online calculator that lets you compare two mortgages. We will keep it simple and not include closing costs and fees. And real quickly, we see that for a 30-year loan, that 1% rate bump will cost you over $58,000 in the life of the loan. Imagine saving $160 every month for 30 years. Now, low credit scores can also increase your auto insurance premiums by as much as double the cost. Research shows that drivers with lower credit scores statistically have a greater likelihood of filing claims, which leads to higher rates. Essentially, having a good credit score helps you save money, but it can also help you earn money. Some employers do a soft inquiry on your credit before offering you a position. So if you don't have a good credit score, you could be limiting your job opportunities and the pay that comes with them. While your credit score can impact your earning potential, it's important to know how much you earn does not affect your credit. Here are other factors that do not affect your credit score. A debt-to-income ratio compares how much money is coming in and what's going out towards paying debt, and is one of the most common misconceptions about credit score influence. There are many people who make a lot of money and have bad credit, and people who don't make much money living paycheck to paycheck but have great credit. The length of time you've worked at an employer or how long you've been living somewhere also has no impact on your score. All of these things may impact whether you qualify for a loan or how much a lender will offer, but have no bearing on your credit score. Remember, the areas you want to focus on are your payment history, credit usage, credit age, mix of credit, and hard inquiries. Put in some time, some work, and remember, improving your credit score isn't about perfection, it's about progress. And if you're not sure where to start, ask for help. Ascentra Credit Union is here to support you with tools, coaching, personalized guidance to help you reach your goals. Your credit journey is just that, a journey. So take the first step and keep moving forward.